So hello everyone again. Thank you very much for joining us for today's panel discussion about fintech reshaping the banking and payment industry. My name is Tamar Katamadze. I'm senior associate at Fridman Law Firm and I will be moderating the panel discussion. Our firm is a boutique law firm based in Soho, Manhattan, and is founded by a prominent New York City tech startup attorney and startup advisor, Neil Fridman. Our firm advises startup companies, VCs, private equity firms on corporate and securities matters. As of the panel discussion, I would like to ask our guest speakers to introduce themselves. Susan, please.
Sure. Thank you, Tamar, and thank you to the firm for asking me to join Pierce and Jeremy today. My name is Susan Sigda, and I'm the founder of Juno Capital Advisors, which is a boutique consulting firm. We serve fintechs, startups, and high-growth businesses in business development and scaling. I am passionate about fintech, having grown up in the banking world where I was involved both in the financing side of the business as well as the trading side, where technology is a critical linchpin. So you could say I've been a user and adopter of fintech since its baby days. And I draw on that experience as well as my work in growth at startups and the advisory work I do at Juno. So I'm happy to be with you today.
Thank you very much. Pierce, please.
Yeah, hi guys. So this is Pierce Crosby. I'm the general manager for a fintech called TradingView. TradingView is based in London, but we have offices in New York, Chicago, Japan, South Africa, Australia, Singapore, you name it. Globally scaled with over 350 people around the world. I lead strategy as well as corp dev, biz dev partnerships, and product.
Thank you. Jeremy, please.
Hi, everybody. This is Jeremy Baksht. I've been in and around this industry for a few decades now. Started my career in tech, spent 8 years at JP Morgan and Citi doing industrials, investment banking, and then the last decade I've dedicated to various fintech pursuits. Have had 2 exits along the way, failed once, and went back to corporate for a few years. Ran the alternative data desk at Bloomberg, and now I'm back in startup land. I've got a stealth startup in the fintech lending space. We've raised 11 million in capital and kind of coming out pretty loudly next month. The company's called Gourmet Growth, but we're going through a rebrand. Essentially, we are helping fund exciting growth consumer brands with non-dilutive capital. They typically are between the seed and Series A world, and enjoying that a lot. And most of what I look at tends to be very data-driven in some way. And I run a syndicate on AngelList. We funded about 6 deals so far this year, called Data Frame Ventures. We try to help entrepreneurs with commercial activities and raising their seed and Series A. Typically, most of them are data-driven into fintech, martech, and agtech. But most of what I like to do is fintech related. So spend a lot of time on various different fintech models.
Thank you very much. Really appreciate the introduction. Really excited to chat with you today. The discussion will be in the Q&A format, and our audience will have a chance to ask questions to the speakers at the end of the session by typing them into the question box in their control panel. Also, we will publish a recorded version of the discussion on our firm's webpage. Before jumping into the discussion with the speakers, I would like to give you a brief overview of the topic. The term fintech and financial technology refers to software and other modern technologies used by businesses that provide automated and improved financial services. Fintech began to flourish in the 19th when the internet and e-commerce business models arose, and in the following decade, banking in most parts was already completely digitalized. The global financial crisis in 2008, in which many people lost their trust in traditional banking system, security and the transparency has become more important than ever. So it became possible to invent new customized solutions and standard procedures such as providing access to banking profile, payment, transfer of money with automatically converted currencies, etc. So due to regulation and high expectations on customers' side, fintech companies' main goal is to create services and implementations with long-term potential. Nowadays, apart from making banking more accessible and rapid, fintech enhance relationship directly with customers through different platforms, such as, for example, crowdfunding. It allows small businesses, entrepreneurs, charities, etc., to provide support without raising money from conventional investors. Also, fintech lead to a disruption of the insurance industry, asset management sector by providing algorithm-driven recommendations, such as, for example, robo-advising platforms, etc. So I have a couple of questions which I would like to address our speakers and hear their opinion about such a fast-growing technology and its impact on the different industry. There are so many buzzwords behind fintech, whether it's AI, machine learning, crypto, etc. Which innovations will be transformed in daily life and which will fall by the wayside? Jeremy, please.
Well, so I mean, there's so many things that I'm excited about in this space. Before I go crazy crypto guy on this panel, I think I would say the most transformational and probably the most long dated and the most frontier tech and risky, of course, is internet layer 2, which is money, transferring money on the blockchain. I think that's the one that is the most exciting. Having said that, I do think similar to 20 years ago with the internet boom, we're going to see 98% of the developments and companies, go to zero. So you have to be very cautious as an investor in that category. But I do think transferring value, recording value, super interesting. I've actually invested in 2 companies that are more focused on tokenizing and sharing assets. And I think that's seminal. There's one in the single family homes area where you actually can receive yield for investing in a group of homes. And it's really nice to be able to have a fractional investment with yield that also has the token component, and the token underlying can increase in value. I think that's fantastic. The amount of paperwork that it would have taken, to invest in real estate, particularly, useful cash flowing real estate, is probably gigantic. But if you believe in the product and can turnkey wire in money or wire in to the token using MetaMask or something in Bitcoin and Ethereum, it's wildly easy now to get yield off of real estate using blockchain. So I guess I mentioned it first. It must be the one that's top of my mind. I do think the other category that I'm involved in day to day is really just capital as a service. When you see the creator economy booming, whether it's for services or lifestyle or legal activity or whatever, that's step one. But I think step 2 is actually building useful products. My company has funded companies like Bev, which is wine in a can, with capital so that they could grow tremendously when they get a purchase order. We use real-time data to basically see purchase orders, D2C daily activity, and we can lend against that and help them avoid dilution. So I think capital as a service can move capital wherever it needs to flow. And if there's a new product or a service that's doing really well, instead of a traditional line of credit or going to a bank or trying to get an SBA loan, which often requires years of history and maybe even positive net income, we're able to see daily, success and lend against that, immediately with really nice terms. So I'd say crypto for sure, very, very interesting. And then capital as a service. My company's raised some money. There are players like Pipe and CapChase, and you probably even saw Yarline was acquired by Thrasio just yesterday. They raised 30 million, I believe, and have been around like 8 months, and now they're owned by Thrasio, which is a unicorn. That whole fulfilled by Amazon e-commerce space and the capital behind it too, in consumer goods, definitely a hot topic. I'll take a pause. I know Pierce and Susan are probably in and around a lot of other really deep activities on financial products, but those are the first 2 I would highlight as very real and already here today.
Thanks. Susan, please.
Sure. I 100% concur with Jeremy about, here to stay developments in fintech on the payment side. And I think, if anything, in the last 12 months, the pandemic completely accelerated all the movements that we've seen in all phases of fintech. But I think the big leap forward that happened that I'd like to highlight is what's happened in the consumer space. When you see data that says like 70% of boomers engaged in mobile banking, many of whom did so for the first time, that shows the huge promise of some of the upstarts in the remittance space. And at the same time, it's really forced international banks and small and medium-sized banks to up their game in terms of their product offering. I think that has, obviously we saw Wise is filing on the London Stock Exchange today, which is a huge validation, much to the chagrin of a lot of investment bankers. But, I think remittance is here to stay, and the idea of lowering payments to consumers is just going to continue to be a huge trend, even as we're seeing some of these payment providers entering new spaces because they want to diversify. Because I look at Stripe, which is just a huge unicorn, and got its start there and has a lot of eminent domain, if you will, but they're getting involved in identity and all sorts of other spheres. So I would say payments is important. I also would highlight new opportunities for financial planning tools as people really have moved their financial management online and on mobile. So I think we're going to continue to see evolutions in betterment. For better or for worse, the democratization of trading is here, and setting aside some of the missteps that Robinhood has experienced on the regulatory front, and I know we're going to get to that later, that's here to stay. So those are some trends that I think are really interesting on the consumer side of the business. I think the third area that I would highlight is identity. Obviously, there's a huge regulatory angle there, but I'm seeing a lot of upstart companies with really simple dev-friendly APIs out there who are going to really gain ground against incumbents and clunkily built banking structures. So I think of like an Alloy, which has just raised a second big round in the identity space, and is now getting involved in transaction processing. But I think that's also going to be an area of huge growth.
Thank you. Pierce, would you like to add something?
Yeah, sure. I mean, I think that we've covered a lot of categories. I mean, broadly speaking, one I guess point that we are very interested in is level 2 companies. In terms of using the analogy from the crypto world, which is level 1 protocols versus level 2. Level 1 are kind of infrastructure and basically the underlying guts of the crypto world, and so broadly speaking, level 2 companies are the actual applications built on top of them. So to compare that to the crypto or to the fintech world, level 1 companies are the Stripes and the Plaids. And so what is much more interesting to me are level 2 companies, which are actually building applications on top of those. And broadly speaking, in terms of the potential upside, I think that, while we can talk about like a Plaid or a Stripe, I mean, Stripe secondary is trading at 150 billion. So it's kind of like, that ship has sailed for any investor who's, kind of early and wants to get in. I mean, you can trade into the secondary market, I guess. But, yeah, so I think that's kind of where we're looking for the most part from kind of a strategic perspective are companies that are taking the guts of what's already been built in these level 1 companies and applying them in a pretty kind of plug and play format. And I think a lot of no code platforms are enabling that to, really quickly enable consumer fintechs to, scale very quickly. I mean, at this point in time, you can have card services, you can have, payments and API rails, banking rails, trading rails. And then, what we do at TradingView is we actually, provide and power a lot of the interfaces for the UI components of these applications. But, safe to say, if you pull all this together, it's kind of like, well, what is really the core application? And I think that that's ultimately what we're looking for, is how people can differentiate outside of those utility functions. And that's really a kind of what we see as that next trend, of the people that can really kind of accelerate, user adoption, and basically focus heavily on this consumer side of things. And yeah, I mean, I think that there's a couple outliers. There's a company called Alpaca that's very interesting, that basically is redeveloping kind of broker API rails, still quite small, but we're growing very fast. Yeah, I'm happy to talk about kind of specific categories for sure.
Thank you very much. So you have talked about the pandemic impact on fintech, and are fintech startups poised to weather an economic downturn? Because these companies and their underlying business models are so new, they are resilient enough to withstand an economic downturn. Pierce, please.
Yeah, I mean, in terms of so relative categories that can win, or ultimately have kind of a chance, or I guess a fighting chance in kind of pandemic times and post-pandemic times. So we've seen a huge shift away from enterprise to consumer. And again, this is probably a bit to Susan's point around not just boomers getting out of the kind of traditional kind of banking world and going kind of digital banks, or kind of these brand new alternatives to banking products. I think that very much is a key trend of folks who can kind of weather the storm. Safe to say, over the course of the last 16 or so months, really kind of since the pandemic started, our business has 4x'd. And so, we are heavily a consumer subscription business, and that's kind of where we focus all of our emphasis and efforts. And so, if you extrapolate our growth and apply that to the larger kind of investing sphere, it's no kind of no surprise that a lot of these kind of consumer apps have really won the pandemic, where a lot of the enterprise and institutional applications have either stalled out or basically failed to gain market share, just as a result of a lot of traditional models where you're servicing a B2B customer. That B2B customer's revenue stream has completely disappeared, especially in the real estate space. And so there really isn't anybody to sell, if you will. And so relatively speaking, I think the shift to consumer is actually for the better. And broadly speaking, that leaves a lot of the B2B side of things kind of in the dust, I think, just in terms of adoption curves, and broadly speaking, a lot of the new revenue streams that are coming online in terms of net new revenue, not just in the US, but on a global scale as well. I mean, we've seen Turkey as an example take off overnight, as well as Brazil, and a lot of India, where for the first time ever, they've had access to kind of really high performance investing tools, as well as kind of commercial banking and real estate banking, as well as consumer banking. This is the first time this has ever been available to them previously, and so that adoption curve is going to be faster and faster in emerging markets as well.
Thank you very much. Susan, please.
Yeah, no, just to piggyback off of some of Pierce's comments, this growth in consumer is huge. And if you think about it just from a financial perspective, if you're an investor looking at business models, it can be a more resilient business model, because if the subscription model, if the product is sustainable, your opportunity to scale is really huge. And I think it's a less risky business proposition, just sort of pure business proposition. The other thing I would say is, if you are a B2B model, in whatever space you're in, you're going to be competing against legacy. Hard to think of somebody like Stripe or Plaid as legacy, but I think they are now, platforms that are really developing similar services in and of themselves. So I think the opportunities for success or the hurdles to success in terms of adoption can be greater, and that really becomes one up, one down. So I think that's why when you look at VC funding in 2020, it really tended to consolidate towards latter stage companies. And so there were a lot more 100 million plus rounds in 2020. And newer companies that may have, a great technology, but that's unproven and that's a B2B model, VCs just don't want to take that up down risk. So, yeah. And as to the international side, there's this great benefit when there's no legacy system. You can leapfrog ahead, and I think that's been, having governments, particularly in the case of India, really be supportive of nascent banking efforts has been huge. And you don't have legacy structures in place, so that really is a really huge driver. And when you look at population growth, the percentage of the Indian population that's 18 and over is going to vastly accelerate in the next decade. So yeah, huge opportunity in emerging markets.
Jeremy, please. Thanks, Suzanne.
Sure. Well, I mean, I think the only thing I'd layer onto that, and I agree wholeheartedly with Susan, is since everything is sort of a barbell, things that are working continue to work and work even better. And then new strategies and new products, like Pierce said, on layer 2 and 3 are super interesting. Everything kind of in the middle has got a little bit stuck in a way that they're drowning in, raised too much money, haven't been able to deploy it, not showing enough success. I see a lot of deals that are looking for bridge financing or in the interim kind of financing because they haven't proven what was expected of them. And yet anybody with some product market fit is very easily raising gigantic rounds, much more about branding and marketing. So if you can glue all these pieces together, and many of the solutions are becoming more and more plug and play, I think the reality of just getting through the echo chamber, establishing a brand, finding that CAC that supports a lot of money being thrown into it, you just see the brands like winning. And I think Pierce, as an example, would understand very well trading apps and things of that nature. I'm seeing, 50 of those come at me, and I'm like, look, there's some great apps in that space, and they're already very popular, and they already have brand. It would take hundreds of millions of dollars for you with features that are twice as good to have any hope of displacement, because people are creatures of habit. Winning on a screen, winning on a workflow, getting on a terminal, getting on an app, you really have to have some extraordinary features or some sort of virality coefficient or some giveaways that get people excited. And I'm maybe talking to B2C, but I almost see that in B2B as well. Nobody wants to be a hero. I remember pitching last year some business development ideas that made a lot of sense to a lot of people I know in corporate for various things I was working on. And nobody wants to take a risk. And even now with the return of risk and growth, nobody wants to take a risk. So unless you have a 2x feature, especially on B2B, nobody's interested in unplugging or replacement. You've got to have hard ROI cases. So I think it just comes back to the point of everything's a barbell. If you're winning and the trend is your friend, the acceleration of that, particularly with free capital, allows people to start doing M&A and consolidation. And then on the smaller scale, somebody with something really magical that can get into a lot of hands can grow very quickly and attract capital. So there is a beauty of entrepreneurship and innovation that's happening in emerging markets that I really appreciate in Latin America and India and places that have, good regulatory rules in place and some real rule of law. I think it's never been a better time to be an entrepreneur, and lots of people, VCs and entrepreneurs, say that kind of stuff, but there's no question in my mind there's never been a better time. Now, having said that, competition's fierce. Lots of stuff is off the shelf. So you have to build something compelling and you have to build momentum quickly, or you're already kind of in zombie land. I see a lot of business models where $1 million or $2 million is possible. People get a little bit of product market fit, and then they get stuck, or they just find their footing and grow like crazy. So I guess my lens is usually around that seed or Series A, where somebody already has built something kind of interesting. And then my interpretation is, can it scale? Do you have the right team? Do you have the right tech? Do you have distribution? Do you have what it takes to be meaningfully relevant over the long tail? Or are you a feature that Amazon, Databricks, somebody really exciting that has a ton of money could just hang off and use their distribution to sort of win share? So I think your original question, though, was about resiliency through the cycle. I think there's a lot of resiliency through the cycle, particularly in tech. Tech is so wildly deflationary that I just think most business models can absorb a fair amount unless they're purely commoditized and it's a race to the bottom on fees. But for the most part, most industries, even if they're competitive, tech is just so wonderfully deflationary and so helpful that I don't fear for this category. Now, commodities, real estate, anything cyclical, when we finally have a correction, which will eventually come when interest rates move up or we have supply shocks or some unrest or some political issues, it's going to hurt all of the cyclicals a ton. I think all that value probably accrues back to tech, which is so enabling to us.
Yeah, and if I could just jump in with one comment on the cycle here, my own personal take is I view current supply chain issues as temporary, and I think the financial markets, freaked out yesterday over the Fed comments. I think vastly unnecessarily. So, I mean, this was I'm going to tell you what I'm going to tell you, what I'm going to tell you in 2 years event. And I certainly don't view a 50 basis point increase in the Fed funds rate as anything to get alarmed about. And, here's the other setting aside inflationary or other shocks that can affect cyclical industries. In tech, there's just, there's so much, sort of stupid to say, but there's just constant innovation and there's a huge amount of capital that's ready and willing to be deployed. So yes, selectively, yes, not in, silly Series A rounds and silly seed rounds. But there's just, when I see private equity firms raising what are essentially VC funds, it makes me feel very, very good about the financial side of the fintech business, which is obviously critical to its growth. But I personally feel very benignly about, supply shocks or the interest rate environment for certainly the next 3 to 4 years.
Thank you so much. As you mentioned, VCs are more focused later stage companies and nobody wants to take a risk. So last couple of years, they have been complaining about the lack of compelling consumer fintech products. And much of this argument revolves around neobanks and how everyone can make a neobank now and how easy it is neobanks to create a debit card. What's the next evolution in consumer fintech beyond neobanks? Susan, please.
I mentioned some of these earlier, really in terms of investment platforms and payments. So I would say that I think in an indirect way of affecting consumers, I think there's opportunity for huge growth in the small to medium size consumer banking, actually the banking side. And that's really in enhancing the pipes that help power those businesses, because those are huge markets. And, I think we spend a lot of time thinking about B2B and enterprise and, what's powering global banks. But I think technology that helps small and medium-sized commercial banks is a huge opportunity for growth. So I look at companies that are helping these banks with just pure open source infrastructure like a Move or a Unit or a Syncture. I think that that's a space that's really interesting.
Thanks. Pierce, please, would you like to add something?
I think that's a good take. I'd say broadly speaking, besides, like kind of mid-market and folks that are servicing kind of consumer fintech. I think, no, I think that's good.
Thanks. Jeremy, please.
Yeah, I'm just thinking about what Susan was talking about before, and I think I think it all comes back to demographics for me. I think Gen Z has never had an opportunity like this before. When I meet with really smart young 20-somethings, I'm just like, wow, you've already studied so much, you've learned so much, you're even teaching yourself how to code. The principles of building in plain sight are just so obvious now that I see this creator and entrepreneurial boom that I think is incredible. I think millennials kind of had it bad going through so many kind of directionally painful cycles and watching that happen. Whereas a Gen X like me,
You think the last 10 years?
I mean, it's been a bad few. Well, other than, if you're invested in, if you already have money, if you're a Gen X or greater like myself, all you had to do was just put as much as you could save into an index fund, and you're now a millionaire. So I do appreciate, sometimes it's better to be lucky than good. I graduated in the late 90s, got an awesome job, came out of MBA in 2005, got an awesome job. I've always been very fortunate to ride the cycles correctly, and I've been pretty shrewd and cautious and saved a lot along the way. So I feel very grateful, and I know the millennials behind me didn't quite get that opportunity. And Gen Z is sort of coming up at a time where if you just have a crazy lucky guess on Doge or something crazy, all of a sudden you have life-affirming wealth for the rest of your life. And I've seen it change lives of certain people. So I think this whole lottery gambling situation that we're seeing amongst retail is really insane. Like my doorman's son is a teenager, and I always ask, what is he trading with his friends? And then I go figure out if that's something I should be trading. Because those momentum things are, they're really happening, whether they should or they shouldn't. The whole textbook of our market's efficient, throw that in the garbage, because obviously things that don't make sense sometimes are incredible investments, just because there's this new crowdsourced, decentralized movement of younger people or people just climbing onto something that doesn't make sense. So it's almost like, in a way, all bets are off for certain fundamental valuation and investing structures that were commonly taught academically to somebody like me. All the rules have changed. So I've been playing in and around alternative data, and I'm an advisor and an investor in lots of cool companies. One of them is called QuiverQuant, and what they do is they take Reddit data and they see what the crowd is talking about, and they tag it and create analytics and signals off of it. And Pierce was at StockTwits a long time, so he knows the power of sort of the crowd and what people are talking about informing potential views. But I think it informs it even more now. Everybody getting behind some sort of decentralized view of, well, AMC probably shouldn't be at 150 or whatever it is today, but we're just going to keep going because it's fun and we hate hedge funds. So I just think citizen journalism and bottoms up, and I enjoy being on Twitter sometimes, not all the time lately, but just understanding the moods and momentum around what's happening in this world it's just incredibly interesting. Like I force myself to unplug on weekends as much as I can and just put my phone down, because the amount of information coming at us is getting impossible to filter. Susan mentioned the Fed minutes. I think I literally saw a headline on Bloomberg was like, oh, 50 points up 2 years from now. Who knows? It's all crazy. And I just put it down. I didn't even read it because I was like, I just can't keep stuffing my mind with all this stuff. Like, I'm not actually a public market investor. So gratefully, I don't really have to, because I think that job is so hard. Trading is so hard, a lot of things that are hard. So I do like to see things like Acorns go public, people just cautiously saving. Like, that's a strange, 1950s, that's my dad's way or mom's way phenomenon, but it's kind of cool. How do you get ahead in life? You just spend less than you make and you save. Even if there's zero yield, at least putting something to the side makes sense. So anyway, I just think I said a mouthful, and I didn't mean to jump around so much. I think it's such a seminal time in history, and certainly the Gen Z entrepreneurs and people I've been meeting, maybe I'm lucky to be in New York around these people. They have tons of ideas, and there's lots of components and things that glue together. I really think there's going to be so many great transformations coming bottoms up and from smart, young, hungry people. It's an exciting time to just be in the industry.
I'm going to jump in if I may there. I concur. And I think it is, for me, the reason I do focus on some of the, more macroeconomic wins is because I think they do have an effect on the pool of capital that's raised by by PE firms and folks who are really kind of in that last phase, pre-IPO phase. And so I think that is something that we have to kind of keep in mind for all those great ideas that want to grow and grow and grow and then go somewhere. I think the other thing we have to look at is acquisition, which is just going to continue to be a huge exit route for a lot of these B2C and B2B2C companies. So, yeah.
Thank you. Yeah, I wanted to ask what is happening in the investment landscape for fintech, including the seed, VCs, private equity, and public equity markets. What's your opinion regarding? Susan, please.
Oh, yeah. I mean, I touched on that to some extent. I mean, earlier, I think certainly seed funding declined while venture funding was up, I don't know, 130 billion last year. I don't know. That was one number I saw. I think it's sort of hard to categorize, but I know seed funding and smaller bite size is definitely down. Was down 2019 versus 2020, and I think investors are becoming more discerning. That's it. And it goes back to the fundamentals: strategy, team, scale, and also to Jeremy's earlier point. You know, what have you done lately? I think if you're one of these firms that's just sort of sliding around in the middle and has anemic growth, there's just not an opportunity to propel yourself forward. And then, you know, companies get into that catch-22 game where they need capital to fuel sales, they need capital to fuel growth, and it's just not available. So I think we're definitely going to see, again, to use your term, the barbell strategy, and one up, one down. And I think that's why the investment community has shifted or devoted more of its money towards more successful structures.
Thanks. Jeremy, would you like to add something, or Pierce?
Yeah, sure. I mean, the thing about M&A that I love so much is, I guess when I was coming up, it was really more about strategic fit and, you know, selling off pieces that you don't need. I advised, you know, GE, Northrop Grumman, big industrial companies, and it was frankly just a ton of fun because you look at their portfolio, and I'm not a genius in my 20s. You know, you look at a balance sheet and you're like, you have a lot of assets here that are non-productive, and you have a lot of divisions. This particular division doesn't make sense. I mean, even a junior analyst in the business can learn the sum of the parts and learn that low multiple businesses are a drag. And you try to find out the legacy of why does somebody have certain puzzle pieces, and sometimes there's no synergy. So I think analyzing large conglomerates and consolidated firms is very fun and exciting. That's kind of like the first thing I learned in finance. So I look back now at that and I'm like, okay, so what happens in the cycles? Large consolidators buy things and sometimes they don't make sense, but money is so cheap, they just do it anyway because the ROI is there. And then through the down cycle, they start to hive off assets that are non-productive because they need the capital or they need help or whatever. So I think we're seeing that now where companies acquire businesses just for fun because money's free. I almost hate to, you know, pick on anybody here. So, you know, sometimes you look at the board configurations of some of these companies and you're like, oh, that person is friends with that person and they rescue that company for fun and to be nice. And that's really what you unpack, and because you don't see any synergy unless you're just missing the joke. But a long-winded way of saying, with capital this cheap, almost everything can be justified. So people like to consolidate and it's fun. And then when there is sort of a reconstruction or whatever destruction of equity value coming, then you have to hive off those assets. So being a banker, being a lawyer, being a service provider in those periods of transformation can be a lot of fun, and it keeps you really busy. But I look at the chessboard of, you know, businesses, and you sort of wonder, like, where is the end when you have $2 trillion companies? You know, just for fun, Apple can buy Tesla and anything else it wants. They're a high branded, you know, product company. They could just chew through every cool high branded product company they want. You know, Apple could buy Nike. You know, like, all these things are just possible through financial leverage or because money's cheap. So you almost wonder how much of that is going to happen. So I do think Apple, Microsoft, the great $1 trillion companies can start to fight each other for these assets, and they probably will. You know, like Bezos for fun buying movie theaters. Well, sure, there's Amazon Prime, and having movies is kind of a giveaway or something fun.
Not just the Academy Awards anymore.
Well, if you want to see it at the Academy Awards, might as well just buy the Academy, right? And
yeah, exactly.
Underlying it. So anyway, I look at it as it's fun to roll the dice and play Monopoly when money's free, and then when money's not free, you have to make some hard choices. So you'll probably just keep seeing consolidation, because why not buy somebody before they take you out or before one of your competitors gets it?
I think it's an interesting opportunity. If I could just jump in and, well, Pierce, I'm sure you have some thoughts here.
Yeah, sure. I mean, it's definitely interesting to look at the landscape when rates are so low versus even a few years ago when cost of capital was, almost double where we are today. I mean, safe to say, yeah, we've looked at a lot of companies, not even from like a value perspective, but just from a hedge your bets perspective, because you never know what next year will bring. And safe to say, if we were to go out into the market right now for debt, I mean, we could raise it almost at zero if we needed to. So with that kind of as the baseline for how the world is considering about different opportunities, it's almost verging on insane, just because why not? And that's kind of the question of a lot of companies is, well, why don't we just go out and raise another huge round because we can. In crypto specifically, I'm pretty sure in the last about 4 months, every major exchange and trading firm has either raised or, as we know, Coinbase has gone public, but most, if not all, have raised at more than a 15x multiple on sales. And broadly speaking, that is a sign to me that people are just throwing money at whatever moves. A lot of these companies have been around for a long time, but the space is so hot that it really doesn't matter. They'll just put a check in, and so I think that it's great. I mean, I think, to be honest, it's a fantastic time to be a founder. When you have some product market fit, you can basically go out into the market, and there's no shortage of cash for sure. I mean, we have investors, basically waiting in the wings for the opportunity to invest in TradingView. We're not taking capital, so no interest. But safe to say, we very much see the scale of cash that is, I guess, sitting on the sidelines or sitting in relatively low risk assets like bonds and whatever that are just declining over time. And so the mandate, I think, what's really happening cyclically, I think, as well as the mandate inside of larger private equity firms is changing, because at the end of the day, investors just want something different than they did 10 years ago.
Yeah.
And to be in kind of a riskless asset, even a couple of years ago, still meant you had some return. But no, if we do expect kind of the inflation rates, that are in front of us, kind of the return on your 1.6% 10-year bonds just doesn't work. So so everything's going downstream, no doubt.
I think I was going to say, I think when I think about the big conglomerates, and I think about what could change or what has the potential for change in terms of the structures of these companies. I think also about regulatory risk. I think that the news of Lena Khan being named to head up the Federal Trade Commission came as a huge shock to the tech industry and to big tech, fintech included. I mean, this is the gal who wrote, the seminal piece as a law student on why, an interesting way of applying antitrust to the regulation of the tech industry. And, she's been involved in a number of congressional projects, including a big House project last year. But I think that regulation is coming. I think that the opportunity for the tech industry to self-regulate, that ship has sailed. And I think companies were very, very focused on their own growth. And trying to play patty cakes in Washington. And I think, these are in the same way, like you're talking about your doorman. There's a guy in my building in New York City who, he's not in our realm anymore, but, he was the lawyer who presided over the breakup of, AT&T 100 years ago. There will be regulatory changes coming down the pike. And I think that what I'm seeing in terms of this new head at the FTC does signal a strong desire in Congress to think about some of these large conglomerates as utilities. And I think that's not going to go away. So I think that's something we really need to think about. And, for me and for the work I do, it's not going to be hugely significant, but, if I'm Bezos or Cook, it's something I'm going to think about a lot. I don't think it hurts consumers, by the way.
Yeah, but what are the greatest challenges, what do you think, facing regulators and fintechs, and how might they respond?
I mean, I think for sure the most important case that we're currently hearing and is in progress is the Spotify case. Broadly speaking, if we actually move past the monopoly framework of Apple, Google, into a more democratic framework where people can launch apps with a very low barrier to entry, I mean, we're very interested in that case. It personally has a lot to do with our business, but safe to say, you're unlocking an insane amount of value for the space. And for those who are not kind of familiar or up to speed, I mean, the rough, kind of cut of it is that any mobile product that includes some kind of financial component has to pay, roughly speaking, anywhere between 30 to 50% of their net revenue that is passed through a mobile application directly to an Apple. And so the Spotify case is obviously seminal. I think there's a lot of other cases upcoming as a result of that case. But the amount of unlock, I mean, if you think about it in billions of dollars, literally just billions of dollars, it's huge, not just for the actual applications themselves, but the second wave of applications that are actually gonna show up as a result of a favorable ruling. And that is, I think, probably the biggest case that we're interested in, and that I think a lot of people in the fintech world are, because all of a sudden their applicability to every single application triples, if not quadruples, in terms of market share and potential companies they can work with.
Yeah, I mean, I think it's really the decoupling of the platform and the goods and services and products that live on the platform. So yeah, it will be transformational. Privacy, by the way, I think is also going to be a huge issue. And again, that has ripple effects across all aspects of the business, data privacy.
Thanks. Jeremy, would you like to add something?
I think the only thing I would add is if I think about life as a consumer of any product, it's all about speed, automation, and a new level of personalization. While to Susan's point, to some extent, getting the benefits of tailored and personalized access without giving up something that makes me uncomfortable. So like if it's 2050 and I've got a brain chip that follows my body structure and understands I might be at risk for diabetes, like does that crowd me out of certain opportunities? Like could I not be president because of that? I might get better personalized medicine, but at what cost? It might sort of be an issue for me down the road. So I think a lot about the trade-offs of the factors of personalization, privacy, with automation and convenience, but how does that cascade through ownership structures? Should one person, Jeff Bezos, who may or may not be one of the smartest people on the planet, should they continue to accrue power such that in a decentralized worldview in 20, 30 years, what if he has his own country? What if he has his own planet? What if he has his own money? And I'm sort of at the bequest of this new king that we sort of let kind of crawl up the ladder. So a lot of really important questions to think about. And as I kind of mentioned, I'm pretty interested in crypto and decentralized aspects and attributes. The most important thing bonding this country together, aside from healthcare and infrastructure, is defense. How do we think about, these big companies that we have keeping us in line or keeping us ahead of, kind of the new Cold War with China, or whatever we're going to call what we're doing with China or Russia. So it's such an amazing balancing act to think about, not stifling innovation while also keeping private powers in check, while also keeping the opportunity for foreign nationals to work here and help advance what we do. So I'm with Susan. I think she's closer to looking at policy than I am. I've learned a lot from her this hour, but look, it's critical to think about this stuff. How do you not stifle innovation and not take away rights from citizens, while at the same time, keeping things in check? I mean, if Elon, Bezos, and 2 or 3 of the 4 people that really actually run this world or run this country decide they'll never pay taxes again and they want to own, the country and have their own new currency, the only thing stopping that is military. So I like to think a lot about decentralized structures, but I also realize the reality of brute force keeps us in check, and without rule of law, we don't have that check. So does the government have to start breaking up these companies? Like what does this cycle look like? And if they do try to break up a company, do you just move offshore? Do you move to the moon? Do you move off planet? Like, where are you going to move your resources? Maybe those are just intellectual resources. I think the other aspect is this 1000x engineer kind of concept, where very large companies may not need huge workforces. So you could put them in Montenegro. You could have the 10 smartest people at Amazon sit outside of the country and sit outside of the law. But it all comes back to taxation, right? I mean, didn't we break away from another country because we weren't getting representation? So I do think there's going to be some battle coming around tax evasion. Anyway, look, I'd love to see a flat tax or something that just makes sense. Wealthy people shouldn't literally pay nothing to keep all these shared services going. So I think I just said a mouthful, but I do stare at the tape and wonder, when does the government intervene? What's encroachment? What's not? When people are complaining about their government telling them to wear a mask, what's going to happen when they tell them to do something else? It's a little bit more precipitous than you have to wear a piece of cloth on your face. So I think there's a lot of people in this country that want freedom, but they at the same time want goods and services. And if those are naturally cheaper because there's one giant company running logistics, then where's that trade-off? Most of this country really needs to save every dollar. And look, Amazon's super fast. I love getting stuff to my doorstep. Faster, cheaper, better. Do I fear them not paying taxes? Do I fear them buying up lots of other companies? To some extent. So I don't know. The government policing all of this is it's curious. Definitely something worth watching.
Thank you very much. Thank you. So we are running out of time a little bit. So it looks like we have covered almost all of our questions. Let me look at if we have anything comes from our audience. But it seems not. So is there anything else you wanted to address before I wrap up? Yes.
Yeah, so broadly speaking, thank you for having us, and generally speaking, very interesting topics to cover. One thing that I'd say in terms of just a final note from the questions, I think one of the topics or conversations is around, I believed it had to deal specifically with VCs finding it hard to find good consumer fintechs. I would definitely push people to really look internationally, because it's interesting that our business is so scaled internationally, but as a result, we see a lot of really out there companies that are doing what companies here did maybe a year ago, but safe to say are becoming market leaders in their own regards. So always think international is going to be quite an interesting story, especially as we have a lot of regulatory headwinds domestically. Yeah, really think it's a great area to explore in the future.
Thank you very much, Susan or Jeremy, if you would like to add something.
Yeah, I mean, I really enjoyed the discussion, and I think I concur with Pierce's observation on the incredible opportunity internationally. I think one of the things that the EU and Europe has done very well that we don't have here. And we have in the last, whatever it is, 2 years, 1 or 2 new banking licenses issued. I think open banking has been transformational in Europe. So it's an exciting time to be doing anything and everything in the fintech space. So thank you for hosting us.
Thank you for accepting my invitation. I've learned so much today, and this has been a fantastic discussion. So I'm sure our audience also enjoyed a lot. Thank you very much for your contribution. Thanks again for joining us today, and we will see you next time.